Welcome to Future Focus, a financial strategies podcast where we make the complex simple. My name is Troy Branch. As always, I shouldn't say always, most of the time, I'm joined here by my advanced planning colleagues, Keely Joe French.
Hello.
And Jacob Messick.
Hey, Troy, I like the casual look today.
It's always something. It's
no,
always
just
something.
Good morning. I like the casual look.
All right.
Yeah.
I appreciate it.
Yeah, you're welcome.
Well, you're in a, well, no. Normally you're in a...
Yeah, it's a little bit more casual.
Okay.
We agreed on casual, and
We
he just
agreed
went
on
off,
casual,
and
he
we went casual.
just went, oh, yeah, exactly.
All right.
Okay, so this is your famous Future Focus sort of digression. Let's just go ahead and dial back in. So we're on episode 20, and for those of you who have made it through episodes 1 through 19, you know in episode 15 we decided that we're going to have a listener episode every 5 episodes. So 15 and 20 and 25 and so on and so on and so on. This is officially listener episode number 2. Okay, and in our listener episodes, what we do is take your questions that you've submitted in comments, and we all work in the at the same company, walking around the halls, and some of our associates will stop us and, hey, I got a question. Great, write it down for the listener episode. So this is what our listener episode is made of and built on, is your questions. So I think we have 4 or so questions today. Otherwise, if we look at the last listener episode, if we do more than 4, there's no way we're getting out of here in the prescribed time. So what we're going to do is we're going to ask a question submitted by you, the listener. Then we'll do our future focus thing. Try to make something that could tend to be a little more complex, simple. Answer the questions and do our best to help folks out as they go about their day, trying to make decisions and trying to gain education. And anything that we say, anything that we talk about is about education. It's not intended to be a specific recommendation. It's not intended to do anything other than educate, and if anything, give you some ideas about perspective, and should sort of, maybe I need to talk to someone, and that's something that you certainly can do. But we're here to educate and probably have a little fun along the way. We good with that?
Yep.
Sounds good. Let's get started.
All right, let's dive in. So I've got because the questions they're long, and to ask them exactly the way it's written, it would be really long. So bear with me for a second. So the first question we have for our esteemed panel is what are the smartest strategies for paying for school, whether it's my own education or whether it's my kids. How do 529 plans fit? Who can open one? So what is a 529 plan? Okay,
what is a 529 plan?
No. Well,
we can take it.
We'll get to that in a minute. I think I like this question because, number one, having kids in different planning stages through planning and thinking about saving for college. I didn't ask this question, but this question is of interest because, hey, this hits me at home. So, I think to start the conversation, the last part of it was, where does 529 plans fit? There's a lot of different strategies that families can use to plan and save for college. But I think a good starting point to ask the question is your goals. Are you wanting to cover all of the college costs? Are you wanting to cover a portion? And then from there, and this is what's going to give us into those plan types, what matters most? Is it flexibility of how funds can be used? Are you looking for something that offers tax benefits, maybe on those contributions coming in or those distributions coming out? Or, how much control as the account owner do you want to have over those funds? So before you start saying, hey, what's the best fit to save for college, I think it's asking those questions to know what's most important to me, and whether I'm saving it for my kids or grandkids, start thinking those questions.
Are you sure you didn't go to law school?
No. Why is that?
Because that was a long answer to say, it depends.
Well, we can't say it depends every single time. Got to provide some, I'm going to say the word that Troy loves all the most, context. You got to provide some context into, here's why we're thinking the way we are.
Everybody hates the extra question, the clarifying question, and right up until everybody needs clarification. So context is my friend.
So let's talk about a specific one then. You
Yep.
mentioned 529 plans, and I refuse to pay for this. We have an agreement that 529 plans are off limits.
I think that's a good place to start because when you're thinking about saving for college, I would say currently most people probably think 529 plans to start. I mean, that's probably what comes to mind the most.
Absolutely.
Actually, I would probably say most people think about saving the dollars.
Yeah.
And then it's like,
Where do I save these dollars at?
where do I save it? And that sort of encapsulates, I think, where you were going with 529 plan, which is it is not sort of a product. It's not it's not a product. It's a wrapper.
It's
if you
a
will.
vehicle. Think of
Yeah.
it like if I was saving for retirement, IRAs, Roth IRAs. So in that manner, 529s is that vehicle of what I'm using to help save towards this goal.
Right.
Absolutely.
So I'm sorry. Go.
So what
ahead.
is a 529 plan? 529 plan is a tax advantage savings program that's usually sponsored through the state. Generally, well, not usually, it is through the state. Earnings are growing federally tax deferred, so anything that you put in is tax deferred growing wise. Your contributions are not tax deductible. Unfortunately, those have to go in. You do have to pay taxes on that.
Depends. I'll put it depends there.
Okay.
Federally. Oh, you
There
said
we
it.
go.
You said it. Not tax deductible, but for some states,
They
and
can be,
they
depending
can
on
be.
the
I think
state.
when I was looking as we're having these conversations, I think there's about 30 states that offer some level of a tax deduction or tax credit for contributions to a 529 plan. So when we go back and we were talking about, hey, what's important? Is it some level of tax deductions for those contributions? 529 plan, at least from a state perspective, offers that ability.
And most
Absolutely.
importantly, and bringing that part full circle, is I can tell you the state of Nebraska, there's tax deduction.
Absolutely. And we are in Nebraska for those that don't know.
For you guys, absolutely.
So your contributions, they grow tax deferred, those earnings. Contributions, as long as they are used for qualified expenses, will also be tax free. So what are qualified expenses? Well, the obvious ones that you may think of is college tuition. Some ones that you might not think of would be like room and board, right? Includes books, it includes off-campus housing and off-campus meal plans, which a lot of people don't realize. But it includes stuff outside of college too. For example, it covers K through 12 expenses for tuition. It also can cover student loans. You can pretty much pay about $10,000 for the life of the student loan from your account without having a penalty. It also covers trade schools, and if you want to use it through K through 12, I didn't mention that you can use a maximum of $10,000 per year. You guys want to add on to any of that? Apprenticeships, trade schools, anything?
I think so far, I mean, kind of crossing off those key points that come to mind. I think you've hit all the four of the main ones that I had. I think another key advantage is, it can be opened by a parent, can be opened by a grandparent.
Anyone, really.
Can be anyone. That account owner retains control over how it's invested, those withdrawals coming out, and you can also change the beneficiary of a 529 plan. So let's say I started a 529 plan for one of my kids, they get through college, maybe they didn't need all of it. One option is I can change the beneficiary to the next kid.
Absolutely.
Hypothetically, you have a 22-year-old who just graduated, but you have a 19-year-old who's in her sophomore year, and decided to go out of state. Hypothetically, asking for a friend.
Yeah, and change it to her. Now you can utilize it in that manner. So that's one of that flexibility that we were talking about.
Now, you mentioned that it is a parent-owned or the creator-owned asset. So the next question is obviously, how does this impact my financial aid for my student? Well, generally when it's parent-owned, there is an impact of there is some consideration there. It is included in that when they fill out the FAFSA, but it's less of an impact than if the student owned the funds outright. Now,
we agreed on 529 plan, and this is probably not the place to do the education piece, but FAFSA, I don't know. I'm just saying, like
you want to fight today?
verdict? I mean,
FAFSA?
what are we voting on, Jacob? FAFSA?
We can take another vote. I like these. I like these votes with three in the room.
Fine. FAFSA is a form that you fill out when you go to college that determines your eligibility for certain funds, scholarships, tuitions, federal grants, etc. So you have to fill it out, and generally what it does is it asks you about your parental assets, because at 18 years old, you probably don't have any assets, and they want to make sure that we're giving them money, they're allocating the funds to the people that need them the most. So yes, when your parent does own the account, it is taken into consideration, but it's not as big of an impact as it would be if the student owned those funds outright. But hey, there's another suggestion. Jacob mentioned that anybody can open these accounts, including grandparents. If your grandparents open the account, Is that considered in your FAFSA application? Nope. We only look at your parents. So
I know you're thinking about 529 plans. You got any room for Grandpa Jacob over there? You know,
Yeah. Yeah.
no,
What?
no,
No.
no. Yeah, I was like, yeah, okay. Well, so what do we got to do to make this happen?
Yeah.
Anyway,
no,
go ahead.
Yeah. No, so I think I know, and those are a lot of those main advantages that come to mind. I know there's higher contribution limits that can go into 529 plans. You know, a lot of it's state specific, but you know, potentially it's up to 235,000 to 590,000 that can go into these plans. So on an annual basis, you know, and obviously there's some gift limits that the person would have to be aware of, but there's flexibility there. I think we're going to talk about a little bit later. We talked about changing the beneficiary to a different child, but you can also now roll those unused 529 plans into a Roth IRA with obviously some restrictions and some guidelines for the beneficiary, so there's flexibility there too.
And that's a clarification because I know with I can't remember if it was Secure Act 1 or 2. There was a question of whether or not you could actually, like, if you were the owner, could you roll it into, say you didn't use it, could you roll it into could you roll into a Roth IRA for the benefit of the owner? And that was kind of out there. It was basically before we got guidance. And so you're saying,
Yes, for the benefit of that beneficiary.
for the beneficiary of the beneficiary, and there's some I'm pretty sure there's some timing issues and how long the beneficiary need to be how long the account needed to be created. I think it's like 15 years.
15 years.
Yeah.
The maximum that you can actually roll over into the Roth IRA is $35,000 for life.
Right.
It is subject to your contribution limits, and I believe for 2026 the contribution limit is $7,500, and you're unable to transfer any contributions that were made within the past 5 years.
Yeah.
I think all those are those advantages, those positives of the 529. Obviously, when we're talking positives and advantages, we probably need to mention some of the not disadvantages, but maybe
Considerations.
downsides and considerations. Obviously, the things that come to mind there are, yes, you have tax-free withdrawals for qualified, educational expenses, but for non-qualified withdrawals, you do get hit with taxes plus a 10% penalty. So if you're not planning to use those funds for education, well, there's tax and penalty to be aware of.
Essentially, it's an IRA.
Yep. And then the other thing that comes the two other things that come to mind there is you may have limited investment options depending on, because these are state-sponsored plans, so depending on what investment options the state allows, there may be some limitations there compared to other alternatives. And then you mentioned it, the 529 does, may impact some financial aid eligibility. So there's just that consideration to be aware of.
Right. So when you think back to, like, just going back to your sort of criteria, the questions that you asked, it's control, it's desire for sort of some sort of tax benefit.
Yeah. Flexibility and control and access.
And access,
what happens if you don't need these funds for college?
What happens
for this person?
What happens if your doctor turns out to not be doctor material?
Yeah.
And we're doing something different.
Yeah,
right?
Absolutely.
So, okay, so let's move forward. We're actually staying in the 529 plan realm, but I want you guys to like, we don't need to cover like all the other stuff that we just covered because we were pretty detailed in that first question. But I want you to think about this because this sort of has large ramifications. With fewer kids going straight to college, is a 529 still the best way to invest in my children's future?
So yeah, maybe your child doesn't want to go to college. That's totally fine. This does cover K through 12, like we said before. If your child is, I would hope your child is in K through 12. I think it is a requirement. It can also be used for trade schools and apprenticeships. So if college, a 4-year college isn't really for you, that's fine. And a lot of people may not think about this because you think college, you think a 4-year institution. It's not required for you to go to a 4-year institution. A 2-year institution is just fine. And maybe you want to take some like certain classes that are available at the college. Sometimes those classes are covered under the 529 plan as well. It just depends on what it is.
Depends on state and what covers. Yeah.
As we mentioned before, even if the child doesn't use these funds to go to college, you can still roll that over into a Roth IRA for their benefit. There's no shame and hurt when it comes to saving early for retirement, especially at such a young age.
No, I think, and so to answer the question a little shorter than what Keely Joe says. I'm going to say it depends.
Oh, okay. I feel attacked.
I'm gonna. Well, because I think he asked the question. I think the answer should be it depends, and
Okay,
then it
he's a
should,
lawyer again.
and then it should be explain that. And so, no, I think it goes back to what we were talking with the first question. What are you trying to accomplish? If you're looking for more flexibility outside of just funding for education, maybe it's using, just a regular brokerage account or a custodial account. There's cash value inside permanent life insurance. A parent who's funding their Roth IRA could potentially take, withdrawals of their contributions into the Roth IRA to use those towards college planning as well too, without any taxes, because you can get to your contributions at any time. So I think it's just there's a lot of options that we didn't really dive into, and maybe it's a separate episode that we talk about all the different options, all the alternatives out there, because I know we can't cover everything in less than a half hour. But because of all those different other planning tools out there, if some additional flexibility is important, but I'm willing to give up on a few things, there's other tools that could be a fit too.
I definitely think we're going to end up back in some form, probably multiple times, because of our filming limitations and the amount of material that's in this particular area.
I don't think it's an either or. Like with everything we talk about, it's not, hey, I have to do a 529 plan and nothing else. A lot of the conversation we have, it's an and situation. It's doing this and this, right. And it's using things in conjunction together to solve those problems and figure out what we're trying to accomplish. So as part of the puzzle, then yeah, and so that those are just the considerations to be aware of. Okay,
good.
All
right, let's move on to number 3. We're going to switch areas, but not really, because I think I said earlier it's essentially an IRA. So we're actually going to move into the IRA space. All right. So question number 3: what should I do with an inherited IRA that must be spent down within 10 years, but I'm thinking about accelerating that and using the funds over the next 4 years?
I think it's honestly just a question of tax bracket management. I know it, like Jacob always says, it depends on what you're trying to do here. But really, when it comes to spending down an inherited IRA within the 10 years, I think.
Do we want to talk on that first briefly about,
sure.
Because I feel like with a larger
Roth IRA,
with larger growing the population having tax deferred accounts, at least from the conversation we have, inherited accounts, inherited IRAs are becoming more and more of a conversation,
especially with tax law change, like with Secure Act 1 and 2, and taking away some of the things like the lifetime stretch. Like I think it'll be interesting.
And you just mentioned that, like you mentioned Secure Act 1 and 2. Before that, if you inherited a IRA, you could potentially stretch distributions from that inherited account over your lifetime. Now you don't have that.
And I was just going to say, and the benefit of that was, if I can stretch those, like if I could stretch those payments over my lifetime, I'm stretching the payments, I'm stretching the overall growth potential, and I'm stretching and I'm lowering, in theory, I'm lowering my tax responsibility.
So if I'm inheriting $1 million and I can stretch that over to a lower amount over lifetime, it's less of an impact, like you mentioned on your bracket management, year over year, as opposed to needing to deplete it over the 10-year period. So for most non-spouse beneficiaries, we'll say most non-spouse beneficiaries, now instead of being able to have that ability to stretch over your lifetime, you have to deplete those assets, disperse those funds within 10 years of that original owner's date of death.
Mm-hmm. Absolutely. Unless you're, I don't even want to say the word because I'm going to have to pay. Can I explain it?
Do you want to say designated eligible
I was going to say a qualified designated eligible beneficiary.
If you roll right into the definition.
So the definition is essentially.
But there can't be a pause like, I'm going on to something else.
It's either a spouse, a disabled child, or a minor child of the person who owned the account. If you're not one of those, then you end up in that, potentially you end up in that 10-year stretch. If you're a trust or a non-individual entity, then it's actually shorter. It's 5 years.
5 years.
So within the 10 years, I think really your question pertains to, like I said before, tax bracket management, which is really managing how much you're going to pay in taxes every year. Let's say you have $1 million. And if you do it over 4 years, you're going to have to take an income of $250,000 every year. That may push you up a tax bracket versus if you take it over 10 years, you only have to take $100,000 every single year.
Yeah.
Yeah, and so that's where, I mean, so if we're there, like, let's say you were planning a bigger purchase. Maybe, you were looking to buy a home or start a business. Maybe it makes sense to accelerate those withdrawals for a shorter period of time, even if it bumps you up a tax bracket, where and then on the other side, maybe you don't have those bigger purchases that you're not planning to buy real estate, start a business, whatever it may be, and it makes a lot more sense in your situation to spread it out over that longer period of time to manage in that perspective. I think that's where talking with a financial professional, when you're in that situation, because it's not one size fits all. It's going to depend on your situation. Talking with the financial professional to see what fits your situation, maybe comparing both those options, running some projections to see if I take it over 5 years, 4 years, if I take it over 10 years, what's the impact? What's better for my situation?
It's funny. I feel like we need to find a new tagline besides, future focus. We make the financial strategies podcast where we make the complex simple. I feel like, it depends on how complex that we're in and how simple we can make it. Right. Like, so it's because it really, like what all these questions speak to, and frankly, what the first 19 episodes have spoken to in some form, almost in every episode. It's always about, it depends, not in a bad way. I know we make fun of it, but it depends, but it's about flexibility. And your situation is going to be different than mine. Yours is going to be different than mine, and so on and so forth. Right?
I think I know a lot of things when we say it depends, and we ask more questions. But I think those additional questions get you thinking about, okay, what do I really want to try to accomplish? And then being able to compare option A versus B, maybe versus option C, to know the different paths, and that way you're able to consider all the impact, because if you're inheriting an IRA, you're taking those distributions, there's some tax considerations to be aware of. And so how does that impact your situation? So asking these additional follow-up questions are good. And I think the last thing that comes to mind on this question is, I don't think for this person who is asking about an inherited IRA for them, I don't think it stops there. I think that's just one piece of that puzzle where start thinking about it for the next generation. Okay, you're inheriting an IRA. The impact. Okay, I got to deplete it, distribute it over 10 years. If you're someone who has a large tax-deferred bucket yourself, should are you wanting to put that next generation, your beneficiaries, your heirs, in that same situation? Maybe you look at some Roth conversions that we've talked about in the past to move those into tax-free dollars. Maybe you look at other planning strategies and tools so that you're not putting that next line, that next beneficiary and heirs in that same situation.
Portugal, here I come. No, just kidding. Okay, so question number 4, final question. And this is another longer.
You're right. This is the final question because Jacob is staying on the roadmap for this episode, and there is
no off ramps.
There's no off ramps.
Okay.
There is no off ramps on this one.
I'm comfortable with no off ramps.
Yep.
So
at least at the moment.
Yeah, at least at the moment, until something strikes you. Hey, look at that. Okay. So, what are the pros and cons of withdrawing? And I'm just, because there's numbers here, and that just overly complicates it. So, what's the pros and cons of withdrawing dollars? We're going to say from the balance of a 401k before 59 and a half, incurring penalties to pay off student loans. And then redirecting, then after the student loan, I'm going to go ahead and assume it says I'm assuming that after the student loan is paid off, redirecting those payments back into the 401k. Does that make sense?
Yeah. I think the main consideration here would be almost like, I guess how to put this, the time value of money. Whether it makes sense for you to keep those funds in a 401k to keep growing at that interest rate, versus taking those funds out, paying the penalty, and paying off your student loans, and then starting from scratch and starting that compounding interest over again from nothing. It also will probably depend on the actual interest rate that you're paying on your student loan. So let's say your money is sitting in your 401k and you're getting a 6% return, but your student loan payment is 4%. Like, that doesn't really make as much sense for you to pull that money out of the 6% to pay off a 4% cost. Whereas if it was 8% cost and you're making 6%, that may make more sense for you to do.
I mean, this is one that is like, as you ask the question, it's like, that doesn't sound like a great idea, but to try to keep it fair and balanced, to think, hey, what are the pros and the cons? And okay, let's lay it out, from a pro perspective first. I mean, really the only thing that really comes to mind is, I guess, that individual, you might be debt-free. You're debt-free sooner. If you're wanting that, you are concerned about debt, you want to wipe out that student loan balance. Hey, that may feel great in the short term, but long-term planning, does that make the most sense? So what satisfies in the short may not be most beneficial long-term, because when you look at the list of cons in that scenario, the considerations to be aware of, you touched on it, taxes and penalties. You take a distribution from a 401k, that distribution is completely taxable. And if you're under 59,
taxable and penalties.
And penalties, if you're under 59 and a half, you have that extra 10% penalty. So let's put some numbers behind that in example. Let's say you wanted to take out $50,000 to, pay off the student loan, and you're a 22% tax bracket in this example. You're going to have to pull, that means it's around $16,000 in taxes and penalties, but that doesn't net you $50,000. To net $50,000, you're going to have to gross that up. You're going to have to take out about $73,000. So that $50,000 withdrawal from your 401k is costing you $73,000. And then you talked about, that lost opportunity cost of what that $50,000 could do growing at 5-6%, whatever that rate of return may be, compounded over quite a few years. If you're 30, 35, 40, you have 20, 25 years until retirement. Think of what that could grow to. So, maybe it makes more sense to, maybe it's a situation where, hey, you put more dollars towards paying down that debt. If you truly want to pay down that debt, maybe you just allocate a few more dollars towards paying it down, still leaving the retirement funds growing and putting dollars there, and you're doing a complement of both.
So for me, I boil this down to, there's times when math is math, right? Like math is math. And there's times when feelings are feelings, right? And those things compete. So to be technical, it's like, it's behavioral finance versus like actual finance.
You know what? You and I, we're like this, because if you look right here on this page, I have right here, it's balancing math versus emotions.
Oh, really?
Yeah.
Actually, we hadn't talked about this.
No,
either.
we didn't. So, I mean, that is the summary point that I put, and it's it's asking yourself, does this decision improve my long-term situation, just to satisfy a short-term problem? And so it's blending math and behavior and emotions together to see, hey, what's going to put me in a better spot, for what I'm trying to accomplish now and down the road.
In the future. Yeah.
Yep.
So I definitely, like, when I kind of shudder when I see pull money out of my 401k. But again, it's behavioral. Like, but I also identify with, I don't want to be in debt.
Especially when those are retirement dollar. That is my retirement goal dollars.
Right.
And pulling those to solve a different need. But whether it's allocating more towards the student loan, maybe it's taking on a part-time job to be able to get additional. I mean, as we talked about one of these last couple episodes, it's that cash flow statement. It's knowing your budget. So maybe it's getting additional income in to allocate it towards the student loans.
To pay it off,
Maybe
but
it's
still continue to build towards retirement.
And maybe it's looking at your expenses to lower expenses to then give you those dollars towards the student loans, but not impacting what you're doing from a retirement side.
Yeah, behavioral, behavioral finance versus like math versus behavioral finance. We'll just call it like that's what this question lends itself to. So I would encourage this listener to sort of take a step back and and sort of work through those feelings of I want to be out of debt versus where do I want to end up from a retirement standpoint.
Especially, I mean, you ask, us, if you said, hey, 3.5%, that's a pretty low interest rate, in the interest rate.
If the interest rate, because
If
I actually didn't say because I left the interest rate out.
And
So
I think
if the interest rate
and I think it's the same thing, whether it's any type of loan, car loan, home loan type of situation. I think that's a factor of it too, knowing,
Yeah.
hey, what has historical borrowing rates been? Where is that at compared to where those dollars are growing? It's, I know it's more questions to think of, but asking those questions really then make sure, hey, is this the right answer for my situation?
anything you learn about Future Focus, how do you make it less complex is ask more questions to figure out where you actually want to be, what's actually important to you. And that's going to vary from, it's very rare that there's a hard, fast rule. At least I think most of us believe it's very rare that there's a hard and fast rule. And you want to develop sort of what works for you in your situation.
Well, and understand what you are doing and why. I think if I say the why is an important part, is that going to make me think like I need context?
Well, I'm just saying, no one wants the extra question and wants to know the why until it's like, well, what do I do?
Yep.
Well, what's important to you?
Well, personal finance is personal.
Personal finance is personal. So,
Yeah.
all right. So, listener episode number 2
Woohoo.
in the books. All right. So, let me see. Let's make sure I wind this up correctly. I want to. I guess I'll do it here. I want to thank everyone for your time and attention. And like I said, we're gonna do these listener episodes because what we found is that your listener questions, directly or indirectly in the hallway, or hey, I'd like to know this. They help drive the topics and the content that we end up talking about. Even outside of a listener episode, but we want to remind everyone to hit like and subscribe, and you can always put your comment, ask your question below, and you may hear your question on a future listener episode of Future Focus.
A future
Future Focus episode. There we go.
So what if you're going to say two futures together?
No, I caught myself, but then you made me do it. So here you go. You'll ruin my outro now.
Yeah.
Way to go.
It still works.
All right.
Try to save it.
Exactly. So again, thanks everyone. We appreciate you. Like and subscribe, and we'll see you on the next episode of Future Focus. Have a great day.